Within less than a single trading session, silver at one point declined by nearly 30%, while silver ETFs and silver mining equities suffered losses that were even more severe. This was not because silver itself had deteriorated, but because the instruments being held respond differently from the price behavior of the underlying metal. Market history consistently shows that after crashes of this nature, the most significant damage does not stem from price itself, but from the decisions made immediately afterward. If you are holding SLV, PSLV, AGQ, or silver miners, the relevant question is not where silver will go, but where you are positioned within the system, and whether your next step is structurally appropriate. Immediately following that sharp decline, a highly familiar phenomenon reappeared, not on the chart, but in market behavior. Liquidity thinned materially. Bid-ask spreads widened. Previously visible buy orders disappeared, and within a very short window of time, a shared sensation emerged across a large number of participants, the feeling that everything is slipping out of one's grasp. There was no need to consult macroeconomic reports. Observing the reaction of the price board alone was sufficient to understand that the market had transitioned into a defensive posture. What is particularly striking is that at that exact moment, physical silver itself did almost nothing. The metal remained where it was. There were no automatic sell mechanisms, no rebalancing, no forced requirement to make an immediate decision. In contrast, financial instruments linked to silver began to react like living entities embedded within a liquidity flow. SLV declined more rapidly than spot silver. AGQ experienced pronounced volatility expansion. Silver mining equities were sold indiscriminately, without distinction between strong and weak operators. The underlying asset was the same, yet the risk experienced by holders was entirely different. For those who have lived through previous market shocks, this rhythm will be immediately recognizable. It is not new. In 2008, physical gold preserved value far more effectively than mining equities. In 2020, physical oil continued to trade, while oil ETFs were forced into disorderly structural adjustments amid panic. Each time markets enter a period of stress, what is tested first is not the asset itself, but the structure through which that asset is held. It is precisely at this point that many participants begin to ask why the pressure feels so intense, even though the underlying thesis on silver appears unchanged. The answer usually lies in a place few are willing to confront directly. It is possible to be correct about the long-term direction, yet positioned incorrectly within the market's reaction chain. When that occurs, the market does not need to invalidate the thesis. It only needs to make the position intolerable.
For non-leveraged ETFs, the risk does not lie in the disappearance of silver, but in the fact that these instruments exist entirely within the financial system. They are traded, priced, and held by participants with extremely short reaction horizons. When sentiment shifts, capital flows can reverse within minutes. Under normal conditions, this dynamic provides liquidity. Under stress, it generates indiscriminate selling pressure. Leverage makes this dynamic more explicit and more unforgiving. As volatility increases, leveraged structures do not allow holders the option to wait. Daily rebalancing mechanisms convert time itself into an adversary. This is why many participants feel they are being ambushed, even though they are not using margin directly. In reality, leverage is embedded within the instrument, operating exactly as designed. Silver mining equities introduce an additional layer of risk. When markets become concerned about monetary conditions, fiscal sustainability, and economic growth, equities are typically sold first. Not because the metal has lost value, but because companies exist within systems of costs, debt obligations, and policy exposure. In defensive regimes, markets do not reward potential. They prioritize survivability. The core issue here is not whether one instrument is good or bad. Each instrument performs precisely the function it was designed to perform. The problem arises when trading-oriented instruments are unconsciously used for defensive objectives, or defensive assets are treated as trading vehicles. During favorable conditions, this mismatch remains hidden. When volatility increases, it becomes the source of panic. From a macroeconomic perspective, the current environment is not unfamiliar. Whenever the global financial system enters a tightening phase, the US dollar tends to become a short-term destination for capital flows. This does not require speculation. Historical data alone is sufficient. In such periods, gold and silver often experience short-term price pressure, even though their long-term defensive role remains unchanged. The difference lies in reaction speed. Physical metals respond slowly, while financial instruments respond immediately. It is precisely this divergence in response speed that creates the perception of collapse, even when underlying structures have not materially changed. This is where contentious questions arise. Is the market attempting to purge leverage? Is the system adjusting itself to reduce accumulated risk? There is no evidence to assert intentional design. However, historical precedent shows that after prolonged easing cycles, markets inevitably seek to test the resilience of complex structures. What makes this discussion important is not the prediction of silver's next move, but the recognition of one's position as the market shifts regimes. Historically, the most severe losses have not resulted from prices moving against expectations, but from participants being forced to act under the worst possible conditions. Structural clarity reduces the likelihood of being forced into action. This perspective defines the approach of this channel. Rather than asking, "Where will price go?" the more consequential question is, "How will I respond if price fails to move in my favor for a sufficiently extended period?" That question is not glamorous, but it determines who remains after each cycle. If silver is held as a hedge against monetary instability, the stress being experienced may not originate from silver itself, but from the structure through which it is accessed. If ETFs or mining equities are held with long-term expectations, yet generate excessive short-term pressure, this signals that portfolio structure requires reassessment, not because the thesis is wrong, but because the market has reasserted the true nature of each instrument. At this point, sharing personal experience becomes meaningful. Where is the pressure being felt? Price volatility, or the sensation of being forced into decision-making? Contributing to the discussion not only deepens collective understanding, but also helps clarify individual positioning within the broader framework. From that clarity, the conclusion returns to the central question. Once the true structure of what is being held is understood, what actually matters most in the next step? After everything we have just observed, this is precisely why what comes next matters more than the decline itself. Not because gold or silver has altered its role, but because every monetary cycle forces markets to distinguish more clearly between defensive assets and the financial structures surrounding them. As global political and economic conditions continue to shift, history consistently shows that gold and silver return to their core function, preserving purchasing power when confidence in fiat currency is tested. This means volatility is not an endpoint, but a phase of repositioning. And this is only the beginning. Changes in monetary policy, fiscal policy, and capital flows will continue to shape markets in the months ahead. How do you believe this will affect the way we view the US dollar, foreign currencies, and defensive assets? Share your perspective. This is Money Cycles, where we examine the cycles quietly shaping the future. Markets move first, but those who understand cycles are never left behind.